Welcome to today's video. We're diving into why getting your first credit card at 18 used responsibly can create a powerful advantage that echoes for decades. We will move step by step, explain the risks, and show you the safest, smartest path to build lifelong credit strength. Here's our roadmap. First, we'll reveal why age of credit matters so much. Next, we'll cover the golden rule of credit and compare your best beginner card options. Then, we'll walk through practical setup steps, utilization and auto-pay best practices, and test your understanding with quick quizzes. Finally, we'll wrap with key takeaways and your next steps. Here's the blunt truth. Your credit score heavily rewards the age of your oldest account. Therefore, if you delay opening a first card, you delay building that age and lose long-term compounding benefits for loans, mortgages, and even rentals. Conversely, starting early gives you runway, but only if you're disciplined. Treat the card like a debit card and never spend money you cannot pay off immediately. The age of your oldest credit line is a fundamental part of many scoring models. Starting at 18 means that by your mid-20s, you may already show years of on-time payments. Next, lenders and landlords often prioritize applicants with proven histories, which can translate to better approval odds and potentially lower rates. However, there is a crucial catch. Missing payments can neutralize or even reverse the advantage. Consequently, the benefit of starting early only materializes when you use the card responsibly. The golden rule keeps you safe. Treat credit like cash. Never carry a balance. Instead, pay the full statement balance every month. Do not be fooled by the minimum payment. It is a trap that leads to interest charges and financial stagnation. Instead, charge only one small, predictable expense you can easily cover, such as a subscription or a tank of gas. Then, set up autopay for the full statement balance so you consistently avoid interest while building positive payment history. Here's a safe starter sequence. First, determine whether you qualify for a student card or should begin with a secured card. Next, select a no annual fee option and immediately enable autopay for the full statement balance. Then, route exactly one small recurring charge to the card. Meanwhile, maintain low utilization by keeping your reported balance well below your limit, ideally under 10%. If you need to spend more during a month, make early payments before the statement closes. Finally, track your score through your bank and, after 6 to 12 months of on-time payments, consider an upgrade to an unsecured card or a higher limit. Let's compare the two primary paths. On the secured side, you provide a refundable deposit that becomes your credit limit. Because the bank's risk is reduced, approval is often easier, and the card can later graduate to unsecured after responsible use. On the student card side, there is no deposit, and the card is designed for those with limited income, but you must verify student status and demonstrate sufficient eligibility. In both cases, the key outcome is building on-time payment history with no annual fee and strict spending discipline. This table highlights practical differences. A secured card requires a refundable deposit and tends to be easier to obtain with limited history. A student card does not require a deposit and targets students, though approval still depends on the issuer's criteria. In both categories, aim for no annual fee, except that beginner APRs are often high, and focus on the true prize, consistent, on-time payments that build credit history. Two levers matter most: utilization and on-time payments. First, utilization is the percentage of your credit limit you are using at the time the statement closes. Aim to keep that reported number under 10%. Second, enable autopay for the full statement balance so you never miss. If you have a larger spend in a given month, make a mid-cycle payment to reduce the balance before the statement cuts. Also avoid cash advances and unnecessary fees, as they add cost without improving your score. Quiz time. The question is, which factor benefits most from opening your first credit card at 18, even with light usage? The options are A. Credit utilization, B. Length or age of credit history, C. Credit mix, and D. New credit inquiries. You may pause the video now to think about your answer. We will discuss the answer in the next section of the video. The correct answer is B. Length or age of credit history. Opening early gives you more years of on-time history, which benefits many scoring models over the long run. Next quiz. What is the safest monthly payment habit for beginners? The options are A. Pay the minimum, B. pay the statement balance in full, C, carry a small balance, and D, pay every other month. You may pause the video now to think about your answer. We will discuss the answer in the next section of the video. The correct answer is B, pay the statement balance in full. This habit prevents interest charges, preserves your cash, and demonstrates reliability. This pie chart illustrates commonly cited FICO factor weights. Payment history is typically the largest component, followed by amounts owed or utilization. Length of credit history, which we're emphasizing today, also carries significant weight. New credit and credit mix round out the model. Keep in mind that exact weights can vary by scoring model and individual credit profiles, but the relative importance of these categories remains directionally similar. Let's lock in a simple blueprint. First, open as early as you can do so responsibly and keep usage light. Next, route one small recurring bill to your card and enable auto pay in full. Then, target reported utilization under 10%. Understanding that under 30% is still acceptable when necessary. Always avoid interest by paying the full statement balance, not just the minimum. Select no annual fee cards because your priority is building history. After 6 to 12 months of perfect payments, consider upgrades or increased limits as your next milestone. This timeline compares two paths. In Path A, opening at 18 allows a long runway of on-time payments through the early 20s. By the time major borrowing decisions arise, such as an auto loan mid-20s or a mortgage near 30, the applicant has a mature history. In Path B, waiting until 25 compresses that timeline, potentially leading to higher rates or stricter terms. The earlier path, paired with perfect payments, compounds advantages over time. Disclaimer: this content is for educational purposes only and does not constitute financial, legal, or tax advice. Your personal circumstances may differ, and credit products vary by issuer and region. Always read your card's terms and consult a qualified professional before making decisions. Here are the major points. Start early if you are disciplined. Always pay in full and treat credit like cash. Use one small recurring expense to generate consistent, positive history. Keep utilization low to protect your score. Prefer no annual fee cards while you build. Finally, evaluate your progress after 6 to 12 months and adjust your strategy accordingly. To wrap up, choose a no annual fee secured or student card, enable auto pay for the full statement balance, and route one small recurring charge to the card. Keep your reported utilization under 10% and maintain a flawless payment record. Track your score month by month, and after 6 to 12 months, explore upgrades as appropriate. Thanks for watching. If you found this valuable, please like the video, share it with someone who needs to hear it, and subscribe for more straightforward personal finance content. Tell us in the comments. When did you open your first card, and what strategy are you using to build your credit?